Welcome back to the Finance Hub UK. This is one of the most urgent updates we have ever covered for UK pensioners, retirees, and anyone with savings over £10,000. HMRC has just confirmed a new set of rules that could dramatically impact how your savings are treated, and if you're over the age of 65, the consequences could be devastating. Many people who have worked hard their entire lives, saved diligently, and done the right thing may now face surprise deductions, tax charges, and even reduced pension benefits because of this new regulation. For millions of over-65s, this isn't just a small technical change, it could mean the difference between living comfortably in retirement or being forced to dip into savings earlier than expected. Today, we will break down exactly what HMRC's rule says, why it was introduced, who it will impact the most, and what steps you can take to protect your money before it's too late. This is not fear-mongering, this is real, confirmed information that every pensioner, carer, and family member should know. If you have savings over £10,000 in ISAs, bank accounts, premium bonds, or even pension pots, you must watch this until the end because we will also give you a checklist of action steps to help minimize the financial blow. The new HMRC rule explained. The first thing you need to know is what this rule actually says. HMRC is introducing a new system that will automatically review the savings and interest income of individuals with over £10,000 in savings. Previously, much of this data was only captured through self-assessment tax returns or by the bank sending data to HMRC annually. Now, this will be automated and reviewed in real time. This means that if you're earning interest over the tax-free savings allowance, or if you are receiving benefits like pension credit that have savings thresholds, you could see deductions, payment reductions, or additional tax liabilities sooner than you expected. Real-time data sharing. Banks will now report interest earnings more frequently to HMRC. Impact on benefits. Savings over certain limits could reduce means-tested benefits. Tax on interest. More pensioners will need to pay income tax on interest earnings if they exceed the personal savings allowance. Why this rule is being introduced? Many people are asking, why now? Why are pensioners and savers suddenly being targeted? The answer lies in government finances and the need to close the tax gap. The UK Treasury is under pressure to raise revenue without directly increasing headline tax rates. By tightening how savings and interest are monitored, the government hopes to capture billions in previously uncollected tax revenue. Unfortunately, this disproportionately affects those who have done the right thing and put money aside. Revenue raising, designed to close the gap of unpaid taxes from savings interest. Fairness argument. Government says everyone should pay the right amount of tax automatically. Technology upgrade. Real-time reporting systems now make it possible to monitor savers' income efficiently. Who is most at risk? The group most impacted by this rule are pensioners and retirees with savings between £10,000 and £50,000. Those with very large sums may already be used to filing tax returns and declaring interest income, but the new system will catch out middle-income pensioners who were previously under the radar. Over-65 pensioners, especially those receiving pension credit or other means-tested support. Homeowners with savings, if you keep cash reserves for care costs or emergencies. Fixed-income retirees, those reliant on savings interest to supplement pensions. How it will affect your benefits. One of the most overlooked consequences of this rule is its impact on benefit entitlement. Pension credit, housing benefit, and even some council tax reductions are means-tested. If your savings cross the thresholds, your benefits may be reduced or stopped. For example, pension credit treats savings over £10,000 as generating a notional income of £1 for every £500 saved. That means £20,000 in savings could reduce your weekly benefit by £20, over £1,000 per year. Pension credit reduction, more savers may see deductions. Housing support affected, could lead to lower housing benefit payouts. Council tax support. Some pensioners may have to pay more council tax. Impact on taxes and interest income. Interest rates have risen over the past 2 years, which means savers are finally earning more, but this also means more people will cross the personal savings allowance threshold. Basic rate taxpayers can earn £1,000 of interest tax-free, but anything above that will now be reported and taxed automatically. Higher interest earnings pushes more pensioners over tax-free limits. Automatic deduction. HMRC may adjust your tax code, reducing future payments. Faster collection. No more waiting until year-end for tax bills. Deductions could be immediate. How HMRC will enforce the rule. The enforcement mechanism is what makes this new rule so significant. Rather than relying on you to declare your savings, HMRC will now receive data directly from banks and building societies and automatically adjust your tax code or benefit entitlement. Direct bank reporting eliminates underreporting. Less room for error. Pensioners could be hit with automatic adjustments without warning. Letters and notices. HMRC will send revised tax codes or payment notices. Protecting your savings. Now that we've outlined the risk, let's talk about solutions. There are legal and legitimate ways to minimize the impact of these changes. Use ISAs efficiently. Interest from ISAs is tax-free and does not affect benefits. Spread your savings. Distribute money between accounts to keep under limits where possible. Keep records. Document interest payments and HMRC letters to challenge errors. Alternatives to cash savings. Another way to manage your exposure is to explore alternatives to traditional cash savings. While safety is a priority for pensioners, there are options that can shelter income from being treated as taxable savings. National savings certificates may offer tax-free interest. Premium bonds. Winnings are tax-free and don't count as interest. Investing carefully. Some investments can generate tax-free growth if structured correctly. What experts are saying. Financial experts are warning that many pensioners will be caught out by these changes simply because they don't check their tax codes or monitor interest earnings. Lack of awareness. Many will first learn of this when they see a reduced payment. Bank responsibility. Banks are warning customers to expect data sharing. Call for simplicity. Campaigners are urging HMRC to make letters clearer. Final warning for savers. This is a final reminder. If you have more than £10,000 in savings, this new HMRC rule will almost certainly affect you in some way. The worst thing you can do is ignore it. Act before the rule takes full effect. Move money into ISAs or spend strategically. Contact HMRC. Ensure your tax code is correct. Seek advice. Speak to a financial advisor if you're unsure. This rule is one of the biggest changes in how HMRC treats savers in years. Pensioners who have saved diligently may now find themselves paying more tax or losing benefits, not because they've done anything wrong, but because the system is now catching every penny. If you are over 65 and have savings over £10,000, act now. Review your accounts, move eligible funds into ISAs, and double-check your tax code. Awareness is the first step to protecting your hard-earned money. Share this video with friends and family so they can prepare. Subscribe to our channel for breaking pension and HMRC news. Leave a comment with your questions so we can cover them in future updates.